Equity markets experienced modest gains on Tuesday, bolstered by China's announcement of a broad monetary stimulus package aimed at reviving its slowing economy. The Nasdaq, known for its focus on technology stocks, outpaced both the S&P 500 and the Dow Jones Industrial Average. As of the third quarter, the S&P 500 is up nearly 5%, bringing its total return for the year close to 20%. However, recent trends show a shift in sector performance, with traditionally interest rate-sensitive sectors like utilities and real estate outperforming, while technology, communication services, and energy have lagged. In the bond markets, mixed signals emerged. The yield on the 2-year Treasury has continued to decline as the Federal Reserve lowers interest rates, while the 10-year Treasury yield has stabilized. This divergence has caused the yield curve to uninvert and steepen, reaching its highest level this year at approximately 0.19%. On Monday, the People's Bank of China, PBoC, introduced a series of stimulus measures to support domestic consumption and combat slowing economic growth. These included cutting short-term interest rates and reducing bank reserve requirements. The PBoC also launched initiatives to stabilize the struggling property and stock markets by injecting liquidity and possibly providing stabilization funds. In response, Chinese equities surged more than 4%, and commodity prices, especially natural gas, saw significant increases. While these efforts are welcomed, there are doubts about whether monetary policy alone can revive China's economy. Additional fiscal measures and government investment might be needed to spur significant growth. Despite the PBoC's aggressive monetary actions, analysts caution that these steps may not be enough to address the underlying issue of weak consumer demand. While the PBoC has injected 1 trillion yuan into the financial system and lowered borrowing costs, there are concerns that poor consumer and business sentiment could limit the effectiveness of these measures. Lower mortgage rates, while beneficial, are likely to encourage households to save or pay down debt rather than spend, further dampening consumption. Economists argue that demand-side policies, such as consumption vouchers and increased government spending, may be more effective in boosting growth. While China has traditionally relied on investment-driven growth, the imbalance between investment and consumption is becoming increasingly problematic. Increasing pensions and medical benefits for lower-income groups could help boost consumer spending, but significant fiscal measures may not be implemented in the near term. Without stronger fiscal support, current monetary policies may have only a limited impact.